Good afternoon. I am Dinesh, Assistant Professor, Department of Commerce. Today we are going to discuss financial management. So what do you mean by finance? Finance is a money the proprietor has to utilize for the purpose of to start or to carry the existing business. And management is a process of getting things done through others or coordination of all the resources. What is this here resource? We are going to take the finance is the best resource the business can be utilized for the purpose of to long-term preview for the business, and we are going to combine with the financial management. What is this here? Financial management is a process of procurement of fund and optimum utilization of whatever the rising funds for the purpose of to achieve the objectives of business. So that is the process will be called as here financial management. Once again, financial management deals with the procurement and optimum utilization of finance for the purpose of to achieve the objectives. So in that objective is main is to earning the profit. So these are the important concept of financial management, and we have four important financial management aspect of financial management decisions. What are those here? Means first one, in financial decisions, that is four important decisions where we are going to take it in a concept. So financial decisions, and second one is investment decisions, and third one is working capital decisions, and fourth one is dividend decisions. There are four important decisions where a company has to take for the purpose of to achieve the objectives. So in that first one, financial decisions deals with the finance, where you can raise, for what you are going to raise, and where you are going to application of funds, and what are the methods and techniques you are going to use in order to utilization of finance. That is the four important process where we are going to take in a case of financial decisions. And also we are going to take the financial decisions in a perspective of identification of source. What is this here? Identification of source. Either you are going to take equity shares or preference shares, or you can also go for switching debentures, or you can also go for bonds, or you are going to take any kind of loan from the or borrowing the loan from the different kind of banks and financial institutions, etc. So these are the business finance where you can raise, and for what you are going to raise the particular identification of source. So process will be says that where you are going to identify your source, and what is the source is applicable to your business. So that is the first process of financial decisions. And second one is procurement of finance. After identification of source, we are going to procurement. There is a proportion where you are going to switch or identification of capital structure based on your cost of capital. So for example, you can take equity and preference shareholders. We need to go for take the cost of dividend. We need to pay regularly towards the shareholders, and also a debenture and bonds or loans, any borrowings from the other institutions or financial institutions, that we need to give the cost of interest regularly to these people. So based on that, we are going to switch the particular capital structure. For example, if a company will be switch some portion, that is in 100 portion, 50 portion of equity and 50 portion of debenture, or 50 portion of equity, 25 portion of preference and 25 portion of debentures, or 50% of debenture and 25 portion of equity and preference shares. Like this, if company has to switch that, they are going to ready to procurement of particular business finance from the general public. After procurement of business finance, we are going to take the part of optimum utilization. We have to go for optimum utilization of business finance for the purpose of purchase of fixed and current assets. That is very important concept of financial decisions. So financial decisions deals with the three important process. First one is identification of source of finance, and second one is procurement of business finance, and third one is optimum utilization of business finance. And there are important methods and techniques we are going to use in a case of financial decisions. What are those here? We are going to discuss two important in that leverages and break-even point method. That is, you are going to take the leverages will be the main concept as per the Bangalore University syllabus. So leverages means a study about the two important variables. One is dependent variable and another one is independent variables. What is this here? Dependent and independent variables. That means leverages is clearly study of two important aspect of business, that is risk and return. So there are important two concept of risk and return. First one is If risk will be increased, return also increase. It will be vice versa. And second case is, if increase the risk, it will be decrease your risk. Sorry, if increase the risk, it will be decrease your return. And if it is decrease your risk, so because of increase your return. So there are two important process where we are going to take in a case of what? Financial decisions. And leverages is mainly depend on the two variables, as I already told that business finance, where you can take in a two aspect of factors, that is risk and return factors. So based on that, we are going to discuss the leverages. That means leverages in simply it defined as it is study of two variables such as risk and return. We are going to take the cheapest cost of sources of fund with the less risk but high return. That is the major concept of investors in a minds where they are going to investing their money. And whatever the portion of we are going to investing, or whatever the portion of we are going to investing their money based on the financial decisions of the company, they are going to fix the important factors of capital structure. That capital structure, based on the capital structure, company may go and raising their finance from the general public. And we have an income statement with regard to the calculation of leverages. We have a types of leverages. So before discussing the types of leverages, let me know that what is that income statement. So income statement, which will be consist of, it will be start from the sales minus variable cost will be getting contribution minus fixed cost will be getting earning before interest and tax. First we need to give the preference for the purpose of payment of interest. That is what we are going to subtracting from the EBIT. Then we will be getting EBT. Again we are going to pay the tax on the whatever the profit we are going to take after deducting the interest, and after subtracting these with the tax means we'll be getting earning after tax. With this we need to give the preferential dividend for the preferential shareholders. Then we'll be getting earning availability to the equity shareholders. With this we need to divide with the number of equity shareholders. We'll be getting earning per share. That means whatever the portion of per share will be earning towards the equity shareholders. With this income statement we need to use for the purpose of to calculation of leverages. What are the types of leverages? First one is operating leverages. With that income statement we already discussed that operating leverages is study of relationship between the contribution and operating profit. Operating profit means here EBIT. So that is the major concept where we are going to take in a case of operating leverages. Formula for the operating leverages is contribution divided by EBIT. We can also call it as percentage change in the sales divided by percentage change in the EBIT. And also we can take that financial leverage. Financial leverage means we are going to take the concept of if two cases, for example, one is absence of preferential dividend and second one is there is a preferential dividend will be given in your problem. So first, absence of preferential dividend in a problem. So there is a study of relationship only between the EBIT and EBT. So that is the major cases where we are going to take in a case of financial leverage. So when we are going to take that EBIT divided by EBT, so with this we are going to take in a concept of when absence of preferential dividend to the preferential shareholder. So when preference dividend are given in a problem, so that time you need to take along with the EBT minus with the preferential dividend and also minus with the tax. So that you need to take the concept of the particular financial leverage. And combined leverage, there is a relationship between the operating leverage and a financial leverage, that both leverages we are going to multiplying, we are getting the combined leverage. These are the three important types of financial leverage. And next we move towards the financial decisions. After that, investment decisions. So investment decisions, so in financial decisions where we are going to rise and what the portion we are going to investing towards the business. But here investment there is some questions which will be arise. What are the portion of investment where we are going to raise the investment of money, or where we go to investing our money to the other business, and what is the risk and what is the return? These are the important questions where it will be appear. We have some methods and techniques in order to identification of the particular risk and return to the different proposals or different alternatives in a business finance. So that is we are going to discuss in a case of what? investment decisions. Investment decisions, we have different kind of methods and techniques. What are those here different kind of methods and techniques means? First we need to take a payback period, and second we need to take a net present value, IRR, that is internal rate of return, ARR, accounting rate of return, and also we need to take profitability index, and we have some kind of what advanced version of internal rate of return will be managerial internal rate of return, and we have profitability index, also advanced profitability index, and we have even payback period, post payback period. These are the important methods where we are going to use in a case of investment decisions. And the third one, we have to go for dividend decisions. What is this here? Dividend is a portion of profit to the shareholders because they are expecting that return. Dividend is a profit portion towards the shareholders, whatever they're investing money, whatever the portion of their money investing to the business. So based on that, they are going to expecting their profit on their investment. And dividend decisions is very necessary because we need to take that dividend, that is the reward for the equity shareholders or preference shareholders. With this only we need to give a portion of profit to them. So with this we are going to take the concept of dividend decisions. Every year we are going to announcement of our dividend portion, that is percentage of dividend towards every annual general meeting in a business. So dividend decisions should be taken by the business for the purpose of to give the dividend to the, what is a portion of dividend we need to give to the dividend to the equity shareholders or preference shareholders. So in simply, dividend decisions which deals with the portion of or proportion of dividend or proportion of profit or proportion of return we allocating to the equity shareholders or preference shareholders on their funds. And we have a dividend decisions in respect of type of dividend. So type of dividend, we have a cash dividend. Company has to go for give the dividend based on the particular profitability of business. They are going to give the dividend as a part of cash. And second one is script or bonus shares, or you can also take, instead of giving the cash dividend, they are going to give portion of dividend. They will be given the portion of dividend money. They are going to issue the shares. So we are not going to give the cash, we are going to give the what? Apart from the against the cash, we are going to give the shares towards the particular shareholders. And we have a bond dividend. Instead of that, we are not going to give the cash, we are just going to issue the bonds to the particular shareholders. And we have a property dividend. So we won't give the cash for them, we won't give the any kind of shares or any kind of bond, we just give the portion of dividend money which have a value to give the property to the particular person as a called as shareholders. Like this, we are going to give the proportion of money in a based on the dividend as a part of their returns in a form of cash, bond, script or bonus shares or property. These are the important types of dividend decisions. And last one, we are going to take the working capital. So this is very important because when we are going to see in every part of the three important decisions which prospective of long term view, but in a case of this which will be in a daily expenses, it's very important. Because of that only we can call it as, it is a relationship between the current assets and current liabilities. That proportion of current assets and current liability will be called as here working capital. Working capital is a process of to know the day-to-day activities of expenses which will be incurred. Whatever the portion of expenses which will be incurred, with that we need to go for investing our money. That portion will be called as here short-term finance, which investing to bear the daily expenses of the business. That is called as here working capital. So working capital is very important because we need to see the business position not only based on the particular long term, we have a short term also. Based on the short term, if we are not able to purchase even raw material, if we are not purchase any kind of materials, or if unable to pay any kind of rent or taxes or small taxes, like if unable to give any kind of electricity bill, that and all will be the day-to-day activities. If it will be incurring towards the business means, that is very important, we need to bear that kind of expenses also. So in these portions we are going to take that two important, as I already told, that current assets and current liabilities. It is a proportion of current assets and it is a proportion of current liabilities. The simple formula for the calculation of working capital is current assets minus current liability. What is this here? What is the proportion we need to take? So 2 portion of current assets minus 1 portion of current liabilities. This working capital is very important. Why? Means when we are going to judge with the operating cycle of the business. What is this operating cycle? It is a process where it will be start from the purchase of raw material. When you are going to purchase of raw material, that material can be sent it to the production. Whatever the production, it will be done by the particular business. They are going to send it to the particular market. Whatever that market, they are going to sell it there. Whatever the respective goods that will be comes towards the customers, customer has to purchase the product of the company, and they are going to give the reward to them, and that reward will be again, it will be start to procurement of materials, and it will be end up with the production, and it will be in a sales in a market. Again it will be comes towards a customer in a point of what business they can go for earning. That is the portions where operating cycle. With this we need to bear that all the business process will be end up with a what, to purchase the material, and also start with the purchase the material. So end up always in a customers, but again we are going to take with the what, a portion of money from the customer, we are going to investing in a short term liability for the purchase of material for the purpose of increase the production. If increase the production, it will be increase the sales. If increase the sales, obviously the profitability will be increased towards the business. Whatever the portion we are going to earning the profit, again we are going to investing for the purchase of product. So these important cases where we are going to discuss in a working capital. So there are 4 important cases where we are going to discuss in a case of what, financial management. So finally financial management, which will be consist of or all addition of investment decisions, financial decisions, working capital decisions, and dividend decisions. 4 important decisions which will be taken by the business organization for the purpose of to earning the profit. So these are the important decisions where the company has to take in order to managing their finance. Thank you.